Hello, I'm Regina McCann-Hess, President of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about IRAs and specifically whether to roll them or not roll them. Now, you do become eligible to make a distribution from your company's retirement plan, either at retirement or when you change jobs. And this is when you may find yourself with a sizable sum of money. Now, this windfall is often referred to as a lump sum distribution. In addition to wondering what you should do with this money, you may have concerns about the taxes and investing issues that you never had to think about before, such as early withdrawal penalties and a 20% mandatory withholding. Because this money could play such a large part in helping to ensure that your years in retirement are comfortable, it is really important for you to understand your options and make decisions that will serve you, your needs now and in the future. Now, the following are answers to some of the most commonly asked questions about lump sum distributions. Among the answers, you will find information on rollover IRAs, which may be your best option to consider for working towards your goals with your retirement funds while offering flexible investment and distribution options. So one of the first questions is, what are the potential drawbacks involved in taking a lump sum distribution? You run the risk of jeopardizing the quality of your future retirement. As more employers allow lump sum distributions, people who might have had fairly modest incomes suddenly find themselves with having to decide what to do with what might be thousands to hundreds of thousands of dollars all at once. Such a large sum of money can tempt people to do things they may regret later. An example would be having worked hard for the past 5 years without a vacation. You may be tempted to take a once-in-a-lifetime trip. And even if you have been financially disciplined, the temptation might still seem too great to resist. Next question would be, can I use part of a distribution for important current expenses? Now, although you may think it makes sense to use part of the lump sum payment to eliminate large outstanding debts or pay off mortgages, a sound retirement can be jeopardized if this money is not used wisely. It may look like a lot of money now, but as people retire earlier and live longer, estimates of how much an individual will need for a comfortable retirement are continually being revised upward. Now, your nest egg may have to be a source of income for the next 20 or 30 years or more. So if you spend even a little of your lump sum prematurely, even to pay down your debts, you may have a smaller nest egg and less income during retirement. Keep in mind that you will have to pay income taxes on any money you withdraw now. In addition, you may be subject to an early withdrawal penalty of 10% unless you meet one of the age or other exemptions provided by the Internal Revenue Code. Another question that I'm asked often is, what if I'm leaving my job and I'm offered a lump sum distribution? One best first step might be to do nothing. In most cases, you will not be forced to take your money out of the company's retirement plan immediately, which gives you time to make careful decisions. If you've been participating in the company's 401k plan, you may be able to keep your money in that plan. Your other options include rolling your retirement money into an IRA or into another retirement plan offered by your new employer. Another question that I get is, what exactly is a rollover? We love talking in acronyms in my field. So what is a rollover? A rollover is a transfer of money from one employer's qualified retirement plan or IRA to another employer's plan or IRA. So in other words, my 401k at my old job going to my new 401k at the new job. Rollovers can keep retirement money tax deferred until withdrawals begin. Another question I get is, how does a rollover IRA work? One of the most popular choices for rollovers is a transfer of the assets from a retirement plan into an IRA, which may offer more investment choices than are available in a 401k. However, You may be okay with the options and enjoy lower costs in the employer plan. Rollovers that are not made directly from one plan to another are subject to strict timeframes, and missing the deadline can result in a tax liability and a possible penalty. A financial advisor or an investment professional can help guide you through the process. To avoid potential complications, a rollover should be made directly between the distributing plan and the receiving plan or IRA. In a direct rollover, no check will be made payable out to you. So that's really important to know, and that affects the taxability of the rollover. Another question that I get, but what if I need the money before I'm 59 and a half? There are many reasons why you may need income, whether it's to take an early retirement, start a business, or sustain yourself while you're between jobs. How you take the distribution and which account you withdraw it from can have an impact on whether you pay any penalties. As an example, if you separated from service after January 1 of the year you turn 55, distributions from your old employer's plan are no longer subject to an early distribution penalty. So if you are between 55 and 59 and a half, moving that money into your new employer's plan or IRA could eliminate potentially favorable tax treatment. If you need to generate income from your retirement plan distribution right away, talk to your financial advisor or investment professional and tax advisor before taking any action. When we're referring to taking money out of your plan after age 55 and before 59 and a half, that's referring to the Internal Revenue Code Section 72T, where your payments will not be subject to an early withdrawal penalty of 10%, as long as you take your money out in what they call substantial equal payments based on life expectancy tables. Now, the IRS has approved 3 different calculation methods, which results in varying levels of payments. However, except under limited circumstances, a tax penalty will apply if you change the amounts or stop payments before the greater of 5 years or the amount of time before you turn age 59 and a half. So in other words, you must continue the payments for the longer of the 2 periods. The next question that I get is an IRA cheaper than my employer's plan? Both employer plans and IRAs may involve fees and investment-related expenses. Since your employer may pay some of the plan's expenses, you actually may find your 401k is less expensive than an IRA that you're considering. Or you may find that the IRA might be a cheaper option. The key is to do a side-by-side comparison of the investment options, the fees, the expenses and services, to find the option that best fits your individual needs. Another question that I get is, how much will it cost in taxes if I take the money right now? Well, you might be surprised. By removing even a small amount from your nest egg, you're opening yourself up to a tax liability and therefore reducing the amount of money that can remain working for you. So let's assume we take a $20,000 distribution. Now, remember, we're under 59 and a half, so we have a tax penalty. We have 20% withholding tax, which is going to be $4,000. And then we're going to pay a 10% early withdrawal penalty of $2,000. And then the additional 2% to get you up to 22% tax rate, which is $400. So you're going to net out of the $20,000, you're going to net $13,600, right? So that is, a big chunk of money going to Uncle Sam, and you're not netting a whole bunch there. But let's assume that, again, you took that and invested that on the other side and weren't going to spend it. That money growing in 10 years would be roughly $22,365 versus that same amount of money, that $20,000 original, still in an IRA or retirement plan, we'll call it tax deferred, is $24,356. So, there's about $2,000 difference there. In 20 years, that gap gets a little bit bigger. on the money that you took out, it grows to $36,778 versus $43,617. So you can see, there is a long-term impact on taking money out prematurely from retirement plans. One of the other items that people say to me is that a rollover might be right for me. What should I do now? So if you decide to roll over your distribution, you're going to need to determine how to invest your money. Among the most popular choices for IRAs are mutual funds, which offer professional full-time management, diversification, and the flexibility to move around from one fund to another as your needs change. Now, keep in mind that all investments, including mutual funds, exchange traded funds, anything that's an investment carries a certain amount of risk, including the possible loss of the principal amount invested. The principal value and return on mutual funds and other investments will fluctuate with changes in the market conditions, and shares, when redeemed, may be worth more or less than their original cost. And a great example of that is if you look at your retirement statement or any investment statement from December year-end 2021, those numbers look fantastic. If you look at your first quarterly statement at the end of March, there's a big difference, and not in your favor, right? The markets have been really tough. So you do have to know that the markets will fluctuate regardless of what you do. If the markets are down, there's going to be fluctuation in your portfolio as well. So, and I'm a big asset diversifier, but, asset diversification does not guarantee a profit or protect against loss. So there's some advantages and disadvantages to rolling your money out of your employer's plan and into an IRA. You will need to compare those features like investment options, services, fees and expenses, withdrawal options, required minimum distributions, tax treatment, and of course, your own unique financial needs and retirement goals. So just be aware that rolling over retirement assets into one IRA account could potentially increase fees, as the underlying funds may be subject to sales loads, higher management fees, a thing called 12B1 fees, which are like internal mutual fund charges, and IRA account fees such as custodial fees. So for assistance in determining if a rollover to an IRA is appropriate for you, you want to talk it over with your financial advisor or an investment professional. Now, some key points. When changing jobs or getting ready to retire, you will need to decide what to do with the assets in your employer-sponsored retirement plan. And a rollover IRA may be right for you, as it can offer the following features and benefits: continued tax-deferred investing, a potential income stream during retirement, easy access to your assets in an emergency, a broad range of investment choices, and a convenient vehicle for consolidating retirement assets. Now, remember, we're just here to educate you about these options. This is not to say that this is what you should do or shouldn't do. It really comes down to your own personal goals and what your goals are for the long term. So definitely want to have a conversation with your financial advisor before making that kind of decision. And I want to thank you for joining me today. Again, I'm Regina McCann-Hess, president of Forge Wealth Management. My website is forgewealth.com, and you can find me on social medias, Facebook, Twitter, and YouTube at Forge Wealth. And on LinkedIn, I'm Regina McCann-Hess. Have a great day, and thanks for joining me.